All right, let's just jump right in. We use this stuff every single day, right? But have you ever really stopped to think about it? Money. You know, the paper in your wallet, the numbers on your phone, it's all part of this kind of bizarre agreement. An agreement that is absolutely fundamental to our entire world. And it turns out, it's one of the most fascinating and frankly, weirdest stories in all of economics.
So this is the core question. Why on earth can we swap this piece of paper for real tangible things? You know, like a car, or a couch, or even just a cup of coffee. I mean, on its own, it serves no useful purpose. Yet we're all obsessed with getting it. We'll trade our actual stuff for it. It's a genuine mystery, and we are going to unravel it.
So first things first, we've got to get this straight. This is a huge idea. Money is not the same thing as wealth. Not at all. Think of wealth as the actual stuff of value. You know, a house, a car, or even a skill you have. Money, well, money is just the tool we all agree to use to trade that wealth back and forth. It's the medium of exchange. Which, funnily enough, is why I can honestly say that Warren Buffett probably doesn't have any more money in his wallet right now than you or I do.
Okay, so with that key distinction in mind, money is the tool, not the treasure. Let's figure out what gives this tool its power. We're going to look at some pretty bizarre examples that really pull back the curtain on the true nature of money. And what you'll see is that so much of its value, it's just a shared belief. It's kind of like a collective illusion we all participate in.
Okay, check this out. In the early 2000s, Somalia had no functioning government, which, you'd think is pretty essential for a currency to work. But these old Somali shillings, with zero legal backing, they just kept working. People kept using them. Why? Well, because the supply was fixed. Nobody was out there printing more of them, and people just agreed to accept them. That's it. It just goes to show you the incredible power of collective trust. Now, if you thought that was strange, let's go to the island of Yap. For centuries, they used these giant stone wheels called rai as money. I mean, they're huge, and to us, that sounds absolutely insane. But think about it. The stones were really difficult to make, and even harder to move around, and that difficulty created scarcity. And scarcity, as it turns out, is an absolutely essential ingredient for anything to work as money.
So, from governmentless paper to giant stones, what's the common thread here? Well, it's that money, whatever it looks like, has to do three basic jobs. It has to be a common measuring stick for value, it needs to hold that value over time, and it has to be easy to exchange. You know, in prison, that role is often filled by pouches of mackerel. Seriously. So, you see, it doesn't matter what it is, as long as everyone agrees that it works.
Okay, so now we know money is just, well, it's whatever we all agree it is. Now, prepare yourself for the next big leap. Because in our modern world, we've taken this idea to a whole other level. Today, we literally create money from thin air.
Just look at how simple this is. Let's say I have $10,000. I go and deposit it in a bank. Now, the bank is required to keep some of it, but it can loan out the rest. So it loans $9,000 to you. Now, here's the magic trick. I still have my $10,000 in my account ready to spend, but now you also have $9,000 to go spend. The total money supply just expanded. And boom, $19,000. That's the mind-bending part. New money was just created. It was willed into existence by the banking system through the power of credit. Now, this is the engine that lets students go to college and lets entrepreneurs start new businesses. But as you can imagine, it's also a source of massive instability.
And if you think that's wild, it gets even crazier and more direct. The central banks, like the U.S. Federal Reserve, they can create money with a literal click of a mouse. 1 second the money doesn't exist, the next second, click, an electronic transfer is made, and $1 billion brand new dollars are suddenly flowing through the economy.
And that, right there, is the fundamental difference. No one, sitting in a room at the Fed, can push a button and have thousands of pouches of mackerel just appear at a bank. This power to create abstract, government-backed fiat currency is totally unique to the modern world. And it's an awesome, and frankly, a dangerous responsibility.
Because the second you have the power to create money out of nothing, you introduce incredible danger. And this brings us to the core challenge of managing any modern economy. It's what you might call the Goldilocks problem. You have to get the amount of money in the system just right.
So get it too hot, and you have the first great danger, inflation. This is what happens when the amount of money grows way, way faster than the amount of actual stuff there is to buy. The classic cautionary tale here is Zimbabwe, where the government printed money so recklessly that their bills literally became more valuable as toilet paper than as currency.
And just to give you a sense of the scale here, at its peak in 2008, Zimbabwe's monthly inflation rate was around, wait for it, 80 billion%. The government actually printed a $100 trillion bill. That's what happens when the punch bowl isn't just left out at the party, it's filled with pure jet fuel.
But here's the crazy part. As dangerous as that is, the opposite problem, getting things too cold, can be even worse. That's deflation. When prices and wages are falling, your debts don't. That mortgage payment you have, it stays the same, becoming a heavier and heavier burden every single month. So what do people do? They stop spending. Because why buy today when things will be cheaper tomorrow? And the whole economy just grinds to a halt.
And if you want to see what this looks like in the real world, you just have to look at Japan. After its massive asset bubble burst back in 1989, it fell into a deflationary trap that led to more than 20 years of economic pain. We now call it the lost decades. For years, their government was desperately trying to create inflation.
So you see the problem, right? It's this incredibly delicate balancing act. The people in charge have to steer the economy right down the middle, between the utter chaos of hyperinflation on one side and the paralysis of deflation on the other. It's this constant, incredibly difficult job of keeping things just right, which of course raises the biggest question of all. Who is actually in charge of this monumental task? Who's minding the store? And what in the world happens when a full-blown panic threatens to burn the whole store to the ground?
You know, if you've ever seen the movie It's a Wonderful Life, you already get it. You understand the fundamental weakness of our entire financial system. That scene, the bank run on the Bailey Building and Loan, that perfectly captures what happens in a financial panic, whether it was during the Great Depression or the 2008 crisis.
And this is exactly how it works. A bank borrows short and lends long, right? Your deposit is short-term. You can take it out any time. But the mortgage it's funding is long-term. So if a rumor spreads and everybody wants their money back at the exact same time, the bank simply can't pay. And here's the scary part. Fear itself, just fear, can cause a perfectly healthy bank to collapse.
So who saves the day? Well, this is where the central bank comes in. It's the institution created to manage the money supply and, most importantly, to act as a lender of last resort. It's basically the financial firefighter that can spray cash, or liquidity, into the system to stop a panic from spreading and burning everything down.
But you know, the kind of hero we need, well, that's changed over the years. Back in the 1970s, the hero was Inflation Fighter Man, modeled on Fed Chair Paul Volcker, who had to be tough and crush runaway inflation with painfully high interest rates. Today, the hero might be deflation-fighting woman, someone who's battling just to keep prices from falling.
And it is a brutal, thankless job. The right decision is almost always deeply unpopular. It's like being the person who has to take away the punch bowl just when the party is really getting good. And that's exactly why central bankers have to be independent from short-term political pressure. They're forced to make these tough calls about a future they can't predict, all while knowing that if they keep bailing people out, it might just encourage even more reckless behavior down the road.
And that brings us right here, to today. The form of money is changing. Again, from paper and plastic to pixels on a screen. But as we've seen, the technology, the actual form, it doesn't matter nearly as much as we think. Whether it's a giant stone wheel, a piece of paper, or a line of code, money always comes down to this fragile balance of scarcity, trust, and stability. So, as we head into this new era, the real question isn't what our money will look like, it's whether we'll trust it when it matters most.